We're seeing an interesting shift among homebuyers across the U.S.
In tonight's Housing Watch, Action News anchor Delia Wrong looks at where Valley cities rank among the hottest and coldest real estate markets.
Fixing California's housing crisis. Today, a bipartisan group of state lawmakers unveiled a series of bills aimed to try to do that.
California's housing empire isn't just cooling, it's unraveling in real time. In the next 12 months, over $200 billion in home value could vanish from the Golden State. That's worse than 2008. Behind the beaches and skylines, buyers have disappeared. Mortgage rates doubled from 3% to 7% in just 18 months, turning an $800,000 home from a $3,200 payment into $5,300. Same house, same neighborhood, but $2,100 more every single month. The math broke. Sellers are panicking. Inventory is exploding. And for the first time in decades, even California's strongest markets are showing cracks. Stay with me, because number 2 isn't Los Angeles or San Francisco like you'd expect. And number 1 will shock you. A city once thought untouchable is now leading the crash. Let's dive into the 10 California cities where housing dreams are turning into financial nightmares. 10. San Jose. San Jose. Silicon Valley's golden child, where million-dollar teardowns were normal and bidding wars lasted minutes, not days. But the tech money fountain just ran dry. Median prices peaked at $1.4 million, now sliding 2% annually. Doesn't sound like much? That's $28,000 in real losses per homeowner. Housing inventory surged 35% year over year. Days on market jumped from 10 to 35. Translation: desperation is setting in. The local economy took a sledgehammer. Google, Meta, Apple, all cutting deep. Remote work policies mean techies don't need $9,200 monthly mortgage payments to live near campus anymore. They're buying $400,000 homes in Austin instead of $1.4 million boxes in San Jose. Insurance premiums spiked 25% after recent wildfire scares. Property taxes on 7-figure homes are crushing dual-income households. First-time buyers? Extinct. Even million-dollar earners are tapping out. But here's the twist. 30% of current listings show price cuts. Sellers who demanded $1.5 million in January are accepting $1.3 million by summer. The untouchable market just became negotiable. 9 Stockton. Stockton, ground zero for California's last housing apocalypse. Prices chopped in half during 2008. The city went bankrupt. Now the warning signs are blinking again. Current median $480,000, down 3% and accelerating. Inventory exploded 45% year over year. Days on market jumped from 27 to 44. Homes sitting like dead inventory. 38% of listings are marked down. That's desperation pricing. Here's why it's imploding. Pandemic buyers from San Francisco treated Stockton like a bargain basement. They bid up prices 40% in 2 years. But remote work is dying. Commutes are returning, and those same buyers are fleeing back to civilization. Local employment is shaky. 7% unemployment while wages lag inflation. At 7% mortgage rates. That $480,000 home costs $3,200 monthly. Most local families earn under $70,000. Do the math. The rental market is collapsing too. Investors who bought during the frenzy are dumping properties at losses. Some neighborhoods are seeing 15% price cuts just to move inventory. History repeats. Stockton swings harder than anywhere during downturns. 8. Riverside. Riverside. The Inland Empire's poster child for drive until you qualify housing. Pandemic buyers fled LA's high prices for Riverside's space and affordability. That party just ended. Median prices hit $575,000, now down 2.5% with analysts predicting another 10% drop. Inventory surged 50% compared to last year. Homes that sold in days now sit for months. 36% of listings are slashing prices. The monthly payment reality check is brutal. At 7% rates, that median home costs $4,300 before taxes and insurance. Add $800 monthly for insurance in fire-prone areas, plus $600 for property taxes. You're looking at $5,700 monthly to live in Riverside. Meanwhile, pandemic-era investors are panic selling. Some bought rental properties at peak prices, realized cash flow is impossible, and are dumping at losses. New construction is flooding the market with fresh supply just as demand evaporates. The commute factor is crushing buyer interest. gas prices, traffic, wildfire evacuation risks. Suddenly, that LA condo looks appealing again. 7. Bakersfield. Bakersfield, California's last affordable refuge where teachers, nurses, and young families could still buy homes. That American dream just got expensive. Median prices near $385,000, down 1.7% and falling. Housing inventory spiked 48%. But here's the cruel irony. Affordable California isn't affordable anymore. At 7% mortgage rates, monthly payments hit $2,800 on the median home. That's crushing for a city where household incomes average $60,000. Add rising insurance costs after drought and wildfire damage, plus inflation on everything else. Families are maxed out. 35% of listings now show price cuts. Open houses that used to draw crowds sit empty. The agriculture and oil sectors that power local jobs are under pressure. Young buyers are looking at Nevada, Arizona, Texas instead. The rental market is cooling hard. Landlords who bought investment properties during the boom are selling. Some can't cover mortgage payments with rental income anymore. But here's the kicker. If Bakersfield isn't affordable, where do California's middle-class families go? The exodus is real. Let's zoom out for a second. We're seeing a pattern across these markets that should terrify anyone holding California real estate. Mortgage rates aren't dropping anytime soon. The Fed is fighting inflation, not bailing out home buyers. Insurance costs keep rising. Tech layoffs continue. Remote work is reshaping where people want to live. This isn't a temporary blip. It's structural change hitting markets that got drunk on free money and speculation. Here's why this matters for you. If you're buying, patience pays. If you're selling, price aggressively now. If you're holding, buckle up. The next 5 cities show just how deep this goes. If you're finding this breakdown useful, hit subscribe. I'll keep showing you the data mainstream analysts miss. 6. Ventura. Ventura. Coastal charm. Surf culture. The kind of place people dream about retiring to. But even paradise can't escape gravity. Median prices hover around $820,000, up just 0.4% annually, practically flat in California terms. Inventory surged 41% across Ventura County. Time on market is rising fast, especially in Oxnard and Camarillo. Nearly 1/3 of listings show price reductions. At 7% rates, monthly payments hit $5,600 before insurance. Coastal insurance rates jumped 20 to 30% year over year after recent storm damage. The tourism economy is softening. Short-term rental bookings are down hard. New Airbnb restrictions are making the investment math impossible. Owners who bought properties as vacation rentals are flooding the for-sale market. But here's the deeper problem. Ventura's economy depends on tourism, agriculture, and retirees with fixed incomes. None of those groups can absorb 7% mortgage rates and $6,000 monthly payments. The correction is happening in slow motion. Sellers are stubborn, buyers are patient. But physics always wins. 5. Oakland. Oakland. San Francisco's grittier, more affordable neighbor with better weather and lower prices. Was the key phrase there? Median prices crashed to $767,000, a devastating 6% annual drop. After the 2021 boom, that's $50,000 in real losses per homeowner. Housing inventory exploded 50%. Over 40% of listings had price cuts in early 2025. The fundamentals are rotten. Tech buyers who flooded in during remote work are fleeing back to San Francisco or leaving the Bay Area entirely. Safety concerns persist. Commercial districts have vacancy rates that look post-apocalyptic. At 7% rates, that $767,000 house costs $5,400 monthly. Most Oakland residents earn under $80,000. The math doesn't work. Even tech workers are choosing Austin, Miami, or Seattle instead. Flippers are getting destroyed. Properties bought in 2021 for $900,000 are selling for $750,000. That's $150,000 losses, plus carrying costs and realtor fees. Some investors are walking away from deposits rather than close on purchases. West Oakland and Fruitvale are seeing 15% price drops. Even upscale areas like Rockridge are barely holding value. This isn't a correction, it's a reset. 4. Sacramento. Sacramento. The pandemic's biggest winner, where Bay Area refugees drove prices up 40% in 2 years. That migration just reversed. median prices peaked at $540,000, now down to $495,000, a 2.5% drop that's accelerating. Inventory surged 46% since 2024. Homes that sparked bidding wars now sit for months. 36% of listings show price cuts. The affordability crisis is severe. At 7% rates, median homes require $3,800 monthly payments. Sacramento's government and healthcare economy can't generate Bay Area wages. Buyers are tapped out. Many Bay Area transplants are selling and moving back or renting instead. The investor crowd pulled out as rental returns evaporated. New construction is adding supply just as demand collapses. But here's what's really happening. Sacramento was never sustainable at these price levels. The pandemic created artificial demand from Bay Area refugees who got priced out when rates spiked. Local real estate agents report open houses are eerily quiet. Buyers tour more homes, make aggressive low offers, walk away easily. The desperation shifted from buyers to sellers. Areas like Midtown and East Sacramento that used to guarantee bidding wars now often sit unsold for weeks. The party is over. 3. Los Angeles. Los Angeles. Hollywood glamour, palm-lined streets, the city of dreams. But the housing market nightmare is just beginning. Median prices across LA County hover around $850,000, but they're sliding 2 to 4% annually in many neighborhoods. On near million-dollar homes, even 2% drops mean $17,000 in real losses. Housing inventory skyrocketed 50% year over year. Over 40% of listings in early 2025 carried price reductions, nearly double the rate from 2 years ago. This isn't just Beverly Hills. Mid-tier areas like North Ridge, West Adams, and Eagle Rock are cooling hard. The payment shock is devastating. At 6.8% rates, the average LA home costs $5,500 monthly, with 20% down, up from $3,800 just 3 years ago. That's $1,700 more per month for the same house. Tech, media, and entertainment sectors are hemorrhaging jobs. Inflation lingers while wages stagnate. Entire demographics of would-be buyers are priced out permanently. The insurance crisis in wildfire zones is adding hundreds or thousands to monthly costs. Major insurers pulled out of high-risk areas, making coverage nearly impossible or outrageously expensive. But here's the kicker. LA still projects glamour, but its housing market is flickering. Rising costs, fewer buyers, mounting inventory, the City of Dreams could become California's biggest cautionary tale. We're getting close to number 1, but don't miss number 2. It shocked me. Subscribe now so you never miss these market reality checks. 2. San Diego. San Diego. Eternal paradise, perfect weather, some of the most expensive real estate in America. Even paradise is cooling fast. Median prices hit $875,000, but after years of relentless gains, we're seeing real drops. 2.1% annually and accelerating. Housing inventory surged 61% year over year. Over 6,000 homes for sale compared to under 4,000 last year. Nearly 40% of listings now show price cuts. Days on market jumped from 10 to over 40, a complete reversal from the pandemic frenzy. The affordability fatigue is crushing. At 7% rates, median homes cost $6,000 monthly. With average local incomes around $85,000, the math is impossible for most families. The job market is cooling in tech and tourism. New short-term rental restrictions are scaring off Airbnb investors. Luxury condo developers are offering incentives and fee waivers just to move inventory. Highly sought-after neighborhoods like La Jolla, Del Mar, and Pacific Beach are experiencing multiple price reductions and slower sales. Open houses that once drew lines down the street are sparsely attended. The rental market is under pressure, too. New apartment construction downtown and in Mission Valley is driving vacancy rates higher while suppressing rents. Paradise isn't immune to market reality. 1. San Francisco. San Francisco, the tech capital, city of bridges, home of sky-high prices. In 2025, this crown jewel is unmistakably cracking. Median prices plummeted to $1.12 million, down $40,000 from 2024, a painful 3.5% slide. Some condo markets are seeing even deeper declines. The Bay Area boom is reversing course thanks to ongoing tech layoffs and remote work appeal. A $1.12 million home demands $7,500 monthly payments before HOA fees and taxes. buyers are simply over it. Housing inventory spiked 43% in 1 year. Homes that garnered 10+ offers now sit for 45 to 50 days without bids. More than 35% of listings are discounted. Even the hottest neighborhoods feel the pinch. Remote work means former residents can buy larger homes elsewhere for the price of a small SF apartment. In iconic areas like Noe Valley and Pacific Heights, homes are quietly being delisted or relisted at lower prices. Condos in Soma and Mission Bay sit unsold for months, with developers offering free parking just to encourage sales. Headlines about retail closures and urban challenges are pushing buyers toward Oakland, the peninsula, or out of state entirely. Tech workers who drove demand are hesitating as layoffs loom. Commercial real estate vacancy rates hit record highs. Empty storefronts mean less foot traffic, hurting the vibrancy that made the city famous. Even rental prices are falling, with thousands of vacant units. San Francisco's reputation as a place where real estate only goes up has finally cracked. For the first time in decades, it's learning what a true housing slowdown feels like. So what does this mean for you? For buyers, patience is your superpower. Time and due diligence win in this market. Check insurance costs, HOA fees, flood risks. Don't rush. Sellers are getting desperate. Negotiate hard. Walk away easily. The power dynamic completely flipped. For investors, cash flow beats appreciation plays now. Avoid negative leverage at all costs. Focus on fundamentals. Rent-to-price ratios, local job growth, population trends. The speculation era is dead. For sellers, price to reality, not to 2022 memories. Every week you wait costs money. The spring bounce isn't coming. Price aggressively, sell quickly, move on. Denial is expensive. But here's the bottom line. This isn't a temporary correction. Mortgage rates staying high, tech layoffs continuing, remote work reshaping demand, insurance costs rising. These are structural changes. California real estate got drunk on free money and speculation. The hangover is just beginning. The cities we covered today aren't experiencing minor pullbacks. They're facing fundamental resets that could take years to stabilize. Some markets might see 20 to 30% drops from peak to trough. Others will see slow bleeds that grind down values over time. But the era of automatic appreciation is over. Protect your financial future. Subscribe and hit the bell for weekly housing market updates. Share this breakdown with anyone considering California real estate. They need to see what's really happening beyond the headlines. What are you seeing in your local market? Price cuts accelerating? Inventory piling up? Drop your observations in the comments. Your insights help everyone make better decisions. The California dream isn't dead, but it's definitely on life support. Stay informed, stay cautious, and whatever you do, don't catch a falling knife. Thanks for watching. I'll see you next week with more market reality checks.